Hi guys, hope you guys are good and welcome back to today's video where we'll be doing an educational video where we'll be studying premium and discount price delivery. And now the objective of this video is to give us an understanding of what exactly is occurring on an institutional level. Because the moment we understand that, we get an understanding of where price is most likely going to draw to next. But now, before we get into that, we first need to ask the question, what do we exactly mean by the institutional level? What do we mean by smart money? Because we always make mention of smart money, but a lot of traders don't necessarily know who or what smart money is. So that's one thing we need to cover in today's video. Another thing we need to cover as well is who exactly is the liquidity provider when it comes to the markets. And now, when we understand these concepts, we can then go into the market and study premium and discount price delivery. And now, you guys will understand, or I'm sure that you've seen, that in most of my videos, what I try to stress more above everything is the concept, because I try to give you guys a concept based perspective and not a model based perspective. And what I mean by a model based perspective is essentially this. So as traders, we all have different models, right? Based on back testing and all of those sorts of things. A model-based perspective is, let's say, for instance, if you're a support and resistance trader, you mark every support, and when price is coming to that support, whether you like it or not, your model dictates that you should be buying off of that support. And that's a model-based perspective, whereas a concept-based perspective is totally different. Because the moment you understand why it works, you'll know when it works. All right. But with that being said, if you guys happen to find the information shared in today's video valuable, I'd appreciate it for you guys on YouTube to subscribe to my YouTube channel. I'd also appreciate it if you'd follow me on my TradingView profile as well. And now the reason for that is because right under my idea section, you will see that I do release my day-to-day analysis, right? In terms of what I'm anticipating on that specific day. So to give you guys an example of this week's trading, this was one of my analysis where I was seeing a bullish draw towards the upside. And like I always mentioned, I do use my TradingView profile as my journal as well. So you'll see all of the reasons as to why I was seeing that draw towards the upside, right? And then also you'll see previous analysis as well, where I was seeing a draw towards this bullish fair value, not fair value gap, but the bullish order block. And then after that, towards the upside, right? And you'll see updates as the market unfolds when objectives are being met, my trading activities as well, more updates, my losses as well. So everything regarding trading, I use my trading view profile, journaling, and all of those sorts of things. But with that being said, let's get into it. Okay, cool. So here we are, guys. So the first things we need to understand is this trio right here. The liquidity provider. Who is the liquidity provider? What do we mean by informed money or smart money? And then what do we mean by speculative, uninformed money? Now, before we go on, I'd like to mention that the concepts that I'm speaking about over here are not necessarily my own concepts, right? I am an ICT trader, and all of these concepts I got to learn through the inner circle trader, right? So if you guys would like to get more information or you'd like to be an ICT trader as well, you can head over to YouTube and look for the inner circle trader, and all of his mentorships are totally free, right? But cool, let's get into it. So the first thing we need to understand is this right here. So this is somewhat of a pulley system, but we need to understand who is the liquidity provider. Is it the speculative uninformed money or is it the informed money, right? And where do we lie as retail traders? Now, here's the misconception. As retail traders, we are large in numbers, right? We're massive in numbers. There are a lot of retail traders. And because of that large, or because of the amount of retail traders, or because of our numbers, I mean to say, we tend to then believe, because of our numbers, that we drive the market, that we are the liquidity provider because of our numbers, which is somewhat hard to believe, right? Because firstly, we're told that 80 to 90% of retail traders fail when it comes to the market. So how is it possible that we dictate where the market is most likely to go to next? A lot of people will say it's because of our buying and selling pressure as retail traders. Well, then let's question what happened to Bitcoin. Everyone was long on Bitcoin, but Bitcoin fell this past 2 years, right? But everyone was long on Bitcoin. So clearly it's not the buying and selling pressure. Another thing as well, we come to realize, and I'm not sure if you've realized this, that there's a manipulative nature about the market. And the market, because of that manipulative nature, it doesn't make the market random. We tend to believe that the market is random, that price is delivered randomly, which is totally wrong. Because I've been in situations where I'm entering trades when I was still starting, right? Entering trades and the market would first take out my stop loss and then continue in my intended direction. And it would happen almost all the time. That doesn't make it random. That's very specific, right? And that misconception itself puts us in a position where we fully don't understand what exactly is occurring when it comes to the market. So this is us over here. We are the speculative, uninformed money. We are not informed that there is a much larger entity that's actually delivering price. But now, who is the informed money? Who do we mean when we talk about smart money or the informed money? Now, smart money is essentially the banks. That's who smart money is. Smart money are all the central banks that own a specific currency. So we understand the currency that's owned by, the US dollar is the one in the States, right? So that bank, that central bank owns the dollar. And now if the currency is owned by the bank, that essentially means that they set the price or the value of that currency. So this price over here is set by the central bank that owns the currency. The same way, if you have a certain store and you're rendering goods and services, you as the owner dictate what you're going to be selling those goods and services for. You dictate it, not the customer. In that same example, we are regarded as as the customer. And now we get the misconception that because we are large in numbers, we dictate the price, whereas it's not the case. We may have some form of influence, but we don't dictate the price. The banks do. The same way when it comes to inflation rates, we rely on news releases, all of these sorts of things that the banks use to manipulate. They are the smart money. All the interest is over here, not over here. Their job is to take money from here because we are regarded as liquidity and bring it over here. That's the simple nature of the market. Therefore, in this pulley system, it's not this way, it's actually the other way. This is the driving force, the small group of people over here, and therefore they are the liquidity provider. I hope that makes sense. But now, since we understand this concept and we understand that everything when it comes to the market is essentially rotating around this space over here, we can then get an understanding of what's happening on an institutional level, especially when it comes to price delivery. And another thing, just to give you guys, um, more things to think about. When it comes to the market itself, 8 trillion is running within the market per day. Can we really say, as retail traders, that we make a large percentage of that 8 trillion? I find that hard to believe, right? But that's just food for thought. But with that being said, let's go into the market now, where we go into premium and discount price delivery. Okay, cool. So here we are. We're going to be looking at premium and discount price deliveries. So the only thing we need is our fib tool, right? And I'm going to mark it from this low because this is the most predominant low after we got this parent price action, this bullish move towards the upside until we reach over there. Cool. Now, we just need to clear off a few things when it comes to the fib tool itself. All you need to understand is all I have is the 50%, which is essentially the midpoint of that high and this low. The 50% is regarded as equilibrium. Now you need to understand what equilibrium essentially means. Equilibrium is regarded as fair value for the institution, right? And by institution, I mean by the banks. It's regarded as a point of fair value. Now, banks operate exactly like us. When the market value is offered at a discount, they are interested in buying. And if that market value is offered at a premium, they are interested in selling. They take note of these prices, right? Because exactly like us as consumers, if something is at a discount, we are immediately interested in investing our money into that, right? Same thing goes for banks. They make well informed decisions. So you need to note that. It's very important. So the equilibrium point is regarded as fair market value. And like I said, once equilibrium is hit, and we're bullish, it means that the market is at fair value and it can be bought on a banking level. So, very important price region over here. So, if you happen to be bullish, you wait for price to reach a point of fair value because those are going to be, you know, prices which are at fair value to look to invest in. What's below the 50% level is regarded as discount prices. The more discount prices, or the more prices are at a discount, the better the investment for you to be looking for buying opportunities. Now, the 62 to 79% level is what ICT regards it as the OTE, or optimum trade entry. This level over here is essentially the percentages which are, very good discount prices. Most of the time, you'll see the market respecting these levels, and then you'll get a reversal off of that level. And then that's the only thing you need to understand when it comes to the fib level, right? Everything that's above the 50% level, that's regarded as premium prices. So you're going to be looking to be selling at a premium and looking to be buying at a discount or at an area of fair value, right? But I hope you, as we continue this lecture, you'll get an understanding of what I'm speaking about. Now, the first thing that I mentioned when we got into this is don't have a model based perspective, have a concept based perspective. And what I mean by that is this: a lot of traders, when it comes to the market, work based on break of structures, right? For instance, over here, they'll see this is a break of structure. So, therefore, the only way I can mark my fib is from this low to that high. That's a model based perspective. What I want you to fully understand is understand the concept behind what I am saying, right? Because to some degree, you know, the market or the banks have a different form of structure, a different way of marking structure. This is us as traders. We see that the market is delivered like this. Therefore, we form a model based on how it's delivered, based on the fingerprints that the banks leave behind. But let's understand the concept. We see that this is the most predominant low, and then we get a movement of price action towards the upside that sets a high. What you're going to be doing is, as price continues towards the upside and a high is formed, right? A high is essentially three candlestick pattern, right? Candle in the middle has the highest high to the one on the left and the one on the right, right? And then we're looking at institutional, not institutional, but intermediate term highs is essentially this high over here is the highest among a swing high towards the left and a swing high towards the right. Now, what you want to note is price pulling back to your area of fair value, and if it doesn't do that, then you continue price action towards the upside, right? Until price pulls back to an area of fair value. Because the moment price is at an area of fair value, you then understand that the institution is now interested in looking to, make investments. This is our predominant leg. From a premium price, we understand that in these areas, price is at a premium, therefore, smart money will look to distribute orders. To distribute is to sell. So they're continuously distributing, and where's their draw on liquidity? Or their next draw, it's an area of fair value, which is the equilibrium price. What we then see is price going into discount prices, goes into our 62 to 79% level, which is good discount prices to be looking to push longs, right? So of course, you're not trading the daily time frame, but you're getting an idea of where price is most likely going to be drawing to next. So when you get this market structure shift over here, it's an indication that we might start continuing towards the upside. What else do we see that is residing in discount prices? At these lows, monitor this. Lows and highs have a large amount of liquidity. What smart money is really interested in is the larger time frames, because on larger time frames, there within those time frames resides large amounts of liquidity, because hedge funds and big corporations have their investments at these lows. If we understand that 8 trillion is running within the market per day, we can only imagine how much money or how much worth of liquidity exists at these lows. So price takes out this low, which is at a discount, right? Which essentially means what? Smart money will look to accumulate longs against these sell stops at a discount price. These sell stops will be regarded as willing sellers to buy against at a discount. So that's why you see price continuing towards the upside. Now, if we have accumulated longs in a discount area, right? Where would we like to see price draw to next? At least an area of equilibrium. So if you're a day trader and you've seen that this low has been set, you're going to be looking for the continuous draw on liquidity towards the upside until price reaches an area of fair value, being the equilibrium, because that's the only point where the market or the banks will be interested in now taking their profits. They take profits or they scale out their profits at an area of fair value. I forgot to mention that. So what do we see? Price goes above the area of fair value. What I'm going to do is I'm just going to flip this around, our fib. We understand that we've accumulated longs against discount prices or these discount sell stops. We push into what? Premium prices. What's residing in premium prices? These highs over here have buy stops residing above them. Premium buy stops, right? Once these premium buy stops are taken, you start to see a reaction within the market. What do we see? The market engineers more liquidity over here. This is how you know that the market is manipulated. This is the banks engineering liquidity, how they'll formulate a certain support zone over here. Look at this, and this happens every time. Not a support zone, but a resistance zone. Continuously, price is pushing towards the downside. Where are the stop losses residing at these highs? What does the smart money do again? Enters a buy order over here because they have the liquidity to do so. Enter a buy order, which continues further towards the upside into premium prices to take out what? More premium buy stops. So all of the liquidity that resided over there has now been swept. So we'll be seen as us retail traders, the uninformed money, will be seen as willing buyers at a premium to sell against. So those are the informed decisions that the bank is interested in. So if they've been selling at a premium, where are they going to be looking to target next? The area of fair value. Now, let me just flip this whole thing around. They sold at a premium against these buy stops. Their next draw is the area of fair value. So after these buy stops are taken, as an intraday trader, because that's what I am, once I get an indication that we're pushing towards the downside and this high has been set, my next draw on liquidity is this area over here. That's my next draw on liquidity. And then below that, what I want to see is discount sell stops, because there's liquidity that's residing below that point. Let me just move this one. My goodness. There's discount sell stops that's residing at this point that the bank is interested in doing what? Buying against. So we had again, this 62 to 79% level. What do we see there? A low has been formed at a discount price. What is the bank interested in doing? Accumulating long orders against these sell stops to push price where? To another area of fair value. So once this low has been established, where's our next draw? Let me just flip this around. The low has been established. Where's our next draw? area of fair value because they've accumulated longs at a discount price against these sell stops, right? They are only going to look to scale out their position once they've reached equilibrium, once they've reached fair prices. So now once we've hit the equilibrium price, this means that the market is at a fair value and can be sold against, right, on a banking level. So all of the accumulated longs that were accumulated over here, once the market gets over there, right, they'll look to take short. They'll start booking those longs or taking profits. And most of the time, they take profits against liquidity, meaning if they've accumulated longs over here, they'll push the market higher into nice premium prices where their premium buy stops resting. So we understand at this high, premium buy stops rest over here. Let's just move this guy. Premium buy stops are resting over here, meaning those long orders that they had initiated down here, they have buy stops over here to sell against to scale out those positions. They'll sell those positions to these buy stops. We see the market going further into a deeper premium over there. And again, this is how you know the market is manipulated. Look at this. Nice. Resistance zone is formed. Market gives us an indication of going lower. This is last week Wednesday CPI release. I was seeing a further draw towards the upside to take out all of these buy stops residing over here because these buy stops will be seen as willing buyers at a deep premium to sell against. So after that has been taken, there and here's the crazy thing, by the way. Last week Wednesday CPI was completely bad for the dollar, was completely against the dollar, right? Which means if the dollar is weak, that means GBP/USD is going to be looking to push towards the upside. But isn't it specific? Once price has taken these premium buy stops, then you get this heavy rejection as if the news didn't even, there was no release at all. The banks use the news releases to fuel their objective. So the news release is a facade, takes us out, and then they enter their order, continues in the intended direction. So that's a key over there, or insights that the markets are actually being manipulated. After these buy stops are taken, what do we see? We see a high has been set. Where's our next draw? We'd like to see the market reach into an area of fair value. Let me just flip this around. So after that high has been formed, where would we like to see the market draw to next? At least a point of fair value, because at that area over there, smart money will look to start scaling out their positions that they had distributed at this high. So where's our next draw on liquidity coming in this week's worth of trading? We may see a continuation lower. Price may still stay in the premium, that's fine, but overall, the overall objective is to see price draw into this area over here, which is this area of fair value, right? And this is excluding other forms of confluence, right? This is just looking at liquidity. And in the beginning of the video, I mentioned once you understand what's occurring on an institutional level, because now we understand what's occurring on an institutional level, we get an understanding of where the market is most likely going to draw to next. We understand that this high has been formed and is most likely going to hold because of all the liquidity that was swept over here, meaning they still have a large order over here. They may have distributed or scaled out some of that order, but they pushed it back into a premium, scaled in more shorts to push the market lower. So the first draw on liquidity is this point over here, the area of fair value. But on a higher time frame perspective, remember, I only move this fib to give you guys an understanding, but we still understand that overall, we are still in a deep premium price. And we'd like to still see the market draw into a discount price. We'll still like to see the market because we see that we are in a deep premium. There's still a likelihood of seeing the market draw into further discount prices, or even as to take out this low over here, right? But that's how you use, you know, that's how you get an understanding of premium and discount price delivery. And you do this on every single time frame, right? With smaller time frames, the idea or the concept itself is fractal. Once you understand the concept, You become very fluid when it comes to the market. That's why, let me just show you guys a few examples. CPI release. Let me just try and find it over here. This was last week, Wednesday CPI release. That's that high that I mentioned that was supposed to be absorbed, right? You start to get an understanding of where exactly the market is most likely to draw to next and why it's going there. It's going there because of the buy stops and because those buy stops add a nice deep premium to sell against. So CPI gets released. After this area is met, this area is essentially these buy stops over here. After they're met, you get a draw towards the downside. Once you get the concept and you continuously practice this, you get a narrative based perspective of things where you get to understand where the market is most likely to draw to next. Look over here. If I have my flip from that low to that high, price is drawn into a nice area of discount prices to look to buy against, right? Again, price pulls back into a nice discount area to do what? To buy against. And once you fully understand the concept, you get an understanding of where the market is likely to draw to next. And I've been repeating myself. So you then add confluence to this. You understand what's residing in discount prices or below the area of fair value, this bullish order block. Therefore, that's my next draw on liquidity. I hope that this makes sense. I know I was repeating a lot of things, but yeah, if you guys do have questions, please do leave them in the comment section. But with that being said, best regards, the architect.